How do you calculate time decay for an iron condor? If you are curious about how to calculate time decay for an iron condor, you are in the right spot. Time decay is an essential concept in options trading, especially for strategies like the iron condor. So, let's break it down in simple terms. Time decay, often referred to as theta, is the reduction in the value of options as they get closer to their expiration date. For an iron condor, which involves selling both a call spread and a put spread, time decay can actually work in favor of the trader. This is because the value of the short options decreases over time, which can lead to profit if the underlying asset's price stays within a certain range. To calculate time decay for an iron condor, you need to focus on the theta values of the four options involved: the short call, short put, and long put. The net time decay effect is the combined theta of these options. Usually, this results in a positive theta for the overall position, since the short options tend to have higher time decay than the long options. Here are the steps to understand and calculate time decay in an iron condor. First, identify the theta for each option. Each option leg has a theta value that shows how much the option's price is expected to decrease per day due to time decay. Next, sum the theta values. You will add the theta values of the short call and short put, which are positive for the seller. Then, subtract the theta values of the long call and long put, which are negative since they are purchased options. The result will give you the net theta for the iron condor position. Now, calculate the daily time decay impact. Multiply the net theta by the number of contracts and the contract multiplier, which is usually 100 shares per contract. This will show you the daily expected time decay profit or loss. It is also important to consider the time to expiration. Time decay speeds up as expiration approaches, especially in the last few weeks. Options that have a shorter time until expiration have higher theta, making the time decay effect stronger as the expiry date gets closer. Lastly, adjust for price movement and volatility. Time decay assumes that the underlying price remains stable. If the underlying asset moves significantly, or if implied volatility changes, these factors can either offset or amplify the effect of theta. In practical terms, traders often use option pricing models or calculators to estimate the theta for each leg of the iron condor. The net theta will indicate how much value the position is expected to lose daily due to time decay. This generally benefits the iron condor seller, as the options they sold lose value faster than the options they bought. For example, if the short call and put options have a combined theta of plus 0.1 per day, and the long call and put options have a combined theta of minus 0.03 per day, the net theta would be plus 0.07 per day. This means the iron condor position is expected to gain about $7 per day per contract from time decay alone. To sum it up, calculating time decay for an iron condor involves adding the theta values of the short options, subtracting the theta values of the long options, multiplying by the number of contracts and contract size, and considering how theta accelerates as expiration nears. Traders can benefit from this time decay since the options they sold lose value daily, ideally allowing them to buy back the contracts cheaper or let them expire worthless, capturing the net credit received when starting the iron condor.